Hey everyone, me Kevin here. The House of Representatives today, 3 hours earlier than expected, voted and passed a bill that threatens to delist Chinese firms from the New York Stock Exchange and the Nasdaq. In this video, I'm going to talk about not only what new information we have on this topic, especially what China has mentioned, but I'm also going to talk about whether or not you should actually be worried. Does this actually affect the companies you're investing in? I'll specifically talk about companies like NIO, Alibaba, Kandi, and Xpeng, but what I'll also do is provide you a resource for figuring out whether you should be worried if you invest in a different Chinese company. This video is going to answer a lot of questions. Now, I first broke this story yesterday, and this video is going to be all about filling in the gaps and the new information. So if you watched yesterday's video, you definitely want to watch this one. If you didn't watch yesterday's video, just watch this one. All right, folks, let's get into this right after mentioning that you should get 4 totally free stocks with Webull. Deposit $100. They still got the promotion going on, so before it goes away, get 4 free stocks with Webull. They did send me an email saying they're going to reduce that offer to 2 free stocks very soon. So get your 4 free stocks. You may as well. All right, so a quick recap. This bill basically requires that companies either certify that they are not foreign owned or they allow audits by companies that are certified with the PCAOB, which is basically like the auditor of auditors. It gets tricky, okay? Now, since not all Chinese companies are audited by PCAOB certified firms, Congress wants uniform double checking to make sure that when Americans invest in Chinese companies, they're investing in honest investments. They might not be good investments, but at least they're honest investments. That's the goal of auditing, to make sure the information being presented is honest. Now, as such, if companies do not apply or comply with these rules and this new bill that is expected to be signed by Donald Trump, then companies could be removed from the New York Stock Exchange or the Nasdaq within 3 years. So yes, worst case scenario, you still got 3 years of sitting around. Now, yesterday, I thought there would only be about a 3% chance that companies like NIO and Xpeng or Alibaba would actually get delisted. But when I mentioned this yesterday, some of you were wondering, but wait a minute, Kevin, why does it matter if a company gets delisted? I mean, after all, the company's still the company. It still has value, like the fundamentals of the company don't change. And this is true. The fundamentals of a company don't change whether they're private or public, but valuation changes. And see, fundamentals and valuations do not always line up. See, when you can trade or hold public stocks, they're much more liquid, and people pay more money for things that are liquid compared to things that are illiquid or harder to sell. If you have to invest in a company that ends up going private and they're like, yeah, we only let you sell your stock once a year, that's obviously a less desirable investment than a company that lets you sell stocks whenever you want by swiping up on Robinhood. In fact, a lot of companies that get delisted might potentially end up listing on like an over-the-counter exchange, but oftentimes you don't even see those stocks pop up on Robinhood, Webull, or M1 Finance. So the reality is, yeah, while it's true, fundamentals don't change whether a company is listed or not, valuation does change because liquidity can drive valuation. And the more people you have investing in something, obviously the more demand there is for a finite quantity of stocks, therefore value tends to go up. That's the benefit of being exposed to a public market that's easily tradable. So yes, again, fundamentals don't change, but when liquidity changes and companies get delisted, you can generally expect the share price to decline substantially. And this is why shortly after this bill was passed, we saw what was a green day for companies like NIO and Xpeng to turn into a red day in after hours. Now, should we be worried about this? Like, what's the latest on this? Well, maybe not, for 2 reasons. Number 1, and I'm gonna butcher all of the Chinese pronunciations, but I will try. Feng Zihai, the vice chairman of the China Securities Regulatory Commission, says, quote, "This is not an intractable problem." And he reiterated that it's very important that Chinese companies have access to international markets, especially those juicy Robinhood investors who pay anything for a company on the trending page on Robinhood. Okay, I added that last part, but the next part is very important too. Do this. Type into Google, NIO Investor Relations. There, you will find an FAQ portion on the websites for the various companies you might be interested in investing in. Like on NIO's webpage, you'll see something that looks just like this. On this page, you'll be able to find out which company audits the company you're thinking about investing in. So you're thinking about investing in a company, which company checks on that company? And then we want to know if the company that checks on the company you're investing in is certified by the PCAOB. To do this, you can go to pcaobus.org. pcaobus.org. Under the Resources tab, you can go to Auditor Search and type in the company. You can just copy and paste it over for the auditing company that matches your investment. In this case, NIO, Alibaba, and Xpeng, all of them use PwC as an auditor, except in different regions, which we'll talk about in a moment. And this stands for PricewaterhouseCoopers. NIO and Xpeng use the Zhongtian Limited Partners branch, and Alibaba uses the Hong Kong branch. Well, good news. PwC shows up as registered with the PCAOB. This is good. This technically means that the companies we're investing in, like NIO and Xpeng, could be exempt from the dangers of delisting because they already get audited by firms that comply with PCAOB firms, or rules and regulations and certifications. So that's good. But wait a minute. What about Luckin Coffee? You know, most of us have heard what happened at Luckin Coffee. It was supposed to be the Starbucks of China, and it went from, oh my gosh, this is the hottest stock ever, we getting rich out here, to, oh my God, the company just got delisted because they had $320 million in Fugazi magic sales, $190 million in Fugazi expenses, and basically the company, poof, gone. That's bad. That's not good. You don't want to invest in a company like that. And after all, it is an auditor's job to make sure that financial numbers are correct, right? That's what an auditor does. You make sure that the numbers on the paper don't just add up, but that they actually represent what's actually happening at the business. That's the point. So what the heck happened to the auditor at Luckin Coffee, and were they PCAOB certified? Well, the auditor was Ernst Young. And when asked about this failure, Ernst Young predictably said it wasn't their fault. In fact, Ernst Young, the accounting firm, said, hey, look, they conducted their audit and they worked totally with the cooperating staff, but the problem was Ernst Young never got to audit their 2019 financials because it wasn't time to do that yet. So in other words, Ernst Young audited the 2017 and 2018 records, but they never got to do their 2019 audit. And so this is where we're kind of like, wait a minute. So what happened at Luckin was there was a bunch of fraud that was discovered before the audit was actually required. So their auditor didn't even matter. The company still got delisted because the employees lied. Yeah, pretty much. Which begs the question, can Chinese companies turn into another Luckin even if they have certified accountants, which guess what? Ernst Young, you type them into the PCAOB certification query box and boom, they're on there as well. They're registered with the PCAOB and it's like, oh, that still happened to Luckin. So like, what good does all this auditing do with this for us if we could still have a Luckin Coffee happen like that? And it makes us wonder, like, what about Kandi Motors as an example? They're the automotive company. Their stock just sold off 32% after a short seller, Hindenburg, accused them, which by the way was the same company that took down Nikola, accused them of basically fabricating their sales by 64% and then storing their sold vehicles into a sister company's warehouse. Anyway, Kandi also uses a PCAOB registered firm. The firm in this case is called Markham Bernstein and Pinchuk Limited Partners. So like, wait a minute. So this bill in Congress requires that Chinese companies listed in the United States use auditing firms certified by this PCAOB to make us feel better and potentially make us safer as investors because government's got to take care of us. Except that's not really true. If we look at the stimulus stocks, none of us would agree with that, but topic for a different video. And so this kind of begs the question then, what the heck? Like, okay, so Luckin Coffee had a PCAOB registered accounting firm, but the accounting firm doing the audit didn't do their audit soon enough, and the fraud got exposed, and the company got delisted all in between the time of the audit, so what good are audits? Kandi still gets bagged on by a short seller and gets destroyed. Fine, maybe NIO and Xpeng and Alibaba won't get delisted, but like, come on, Congress, what's the point of all of this? And what should we do about it? Well, here's my POV. Look, I said yesterday, I think there's only a 3% chance of NIO and Xpeng getting delisted. After this additional insight on the accounting firms that they use, I think we're substantially under a 1% chance of seeing any of these Chinese companies get delisted, especially with the Biden administration coming up and Chinese officials saying, yeah, with the Biden administration coming up, don't worry, we'll be fine. In so many words. But there's still 3 things that we can do to kind of help with this anxiety of potentially getting scammed by a foreign company. Number one, the easiest thing you could do, don't invest in foreign companies. If you're really worried about it, just don't invest outside your scope or region. I personally really enjoy being able to walk into an Apple store or Tesla, and well, maybe not a Tesla store anymore, but I could call up a Tesla and go, hey, yo, Tesla, I want some solar panels on my house, and I could experience the process myself. In fact, if you want to quote some Tesla solar panels, I highly recommend you check them out. They're super inexpensive. You could even lease them, call them up and go, I don't want to pay anymore, and they stop charging you. It's great. No long-term contract you have to sign. Use that referral link down below and you'll get a bonus offer back. It's awesome. Everybody likes bonuses from Tesla. But anyway, I like to know what the customer is feeling. I know that about Tesla and Apple, but I don't know that about Xpeng and NIO, for example. I have to rely on reports and videos, which is never the same as actually experiencing a company yourself. Maybe I'll travel there one day, but I don't think English or German are going to get me very far there. Hallo, wo ist the NIO? It's just not gonna work. Number two, if you invest in Chinese companies, check the history of the auditors that the companies use. This can get complicated though, because this means like, look, if you're looking into Alibaba, they use PwC, but they use the Hong Kong branch. So then you'd have to look at the history of the Hong Kong branch versus the Zhongtian location. Oh, it's exhausting. So like you can analysis paralysis yourself to death here. As option number two, but that's still not going to help you get over a Luckin coffee situation where the auditing wasn't what mattered. It was lying employees and fraudulent employees that were the problem. So if you don't want to do number one, which means, in other words, you want to still invest in foreign companies and you don't want to look up auditors because it's complicated, well, here's the next best thing you can do. Get your 4 free stocks with Webull, of course. You could diversify. And look, I know this sounds like blasé, like, oh my God, seriously, like that's where you're gonna leave it. Think about it, folks. Honestly, any company you invest in could go bankrupt. And it's so much easier to sleep at night if you look at your portfolio and you go, look, I got 50 stocks, I got 40 stocks or 30 stocks, and each of them has like a 3 to 5% position. No way, worst case scenario, if one of them gets the rug pulled out from under them, and like how many companies could you possibly pick that are gonna go bankrupt? Now look, if you invested in the last 10 years into JCPenney, Sears, you know, and what's another one, Kodak or whatever, okay, maybe you should stick to index funds. But for the vast majority of people, we don't usually have to worry about these massive frauds or these massive bankruptcies. And the easiest way to potentially deal with that risk factor is just be diverse in the stocks that we're choosing. Keep the shares of maybe your Xpeng and your China down to 2.5%, maybe 3% of your portfolio. So that way, if one of them goes bye-bye, hey, you know what? I guess your 10% return or whatever your rate of return you're aiming for or trying to get is 7.5% this year. Hey, you're still doing good. So that's my POV on all of this. If you found this helpful, consider subscribing. Really appreciate you watching. Consider sharing the video. And folks, we'll see you next time.